In this video, I want to talk about why a regular portfolio rebalancing is key to long-term investment success. Regular portfolio rebalancing, is a key to long-term investment success. So rebalancing a portfolio involves adjusting the allocations of assets, back to their target percentage to maintain the desired level of risk and returns. And regular rebalancing offers several key benefits that can improve portfolio performance and help achieve financial goals. So most of the times, discover that the asset allocation may go out of what it was intended to be. So in that case, you rebalance so as to be able to obtain, to come back to the optimal level of allocation to different assets you had in mind in the first instance. It's very, very important. It's an important practice you carry out as an investor. So you first of all consider, maintenance of your risk return balance, maintenance of your risk return balance. So in this case, you are going to prevent risk drift and as well as adapt to changing goals. Let's look at how to prevent risk drift. Over time, market movement can cause certain assets to certain asset class to become overrepresented. When you initially invest, all things may look kind of the same or equal depending on your allocation, but as time goes on, a particular asset class may outgrow some other ones. So in that case, you will need to readjust to be able to keep them at optimal desired level of allocation, and so that they will not become over concentrated or overrepresented. And if you leave it like that without rebalancing, it will likely increase your portfolio risk. So rebalancing regulates your allocation to the intended risk level. So as you rebalance your portfolio, you want to mitigate risk and stabilize your portfolio in a shape that will make you comfortable, that will help you to sleep well at night. In other words, you de-risk the portfolio. So not only that, you adapt to changing goals. As financial goals evolve, rebalancing ensures that the portfolio reflects your current needs, such as shifting to more conservative investments as retirement approaches. Usually, as a young investor, you have a different, investment goal, and you could accept, or endure a higher level of risk. As you grow older and you're getting towards retirement, the need for you to adapt to that particular change. And in your age bracket, considering the fact that time is fast, going, and you may very soon retire, so you need to do something about that by rebalancing your portfolio. Number two is encourages disciplined investing. Rebalancing your portfolio kind of encourages a disciplined investing. In this case, you reduce emotional decision making. It reduces emotional decision making. Rebalancing is based on a systematic approach, not market emotions. It prevents, chasing high performance assets or high performing assets or panic selling during a downturn. If you are, are well grounded in the market, you should be as emotionless as possible, actually. So you don't really panic when the market is down, and you don't chase high performance, during a period of euphoria in the markets. And not only that, it promotes long-term thinking. Regular portfolio rebalancing promotes long-term thinking. All right. So by sticking to a predefined allocation, rebalancing keeps you focused, on your investment strategy rather than short-term market fluctuation. It keeps you focused, it keeps you grounded, and it helps you to be able to focus on the long term. And you don't get distracted by whatsoever might be happening, in the short term, in your portfolio. Number three is enhances diversification. Uh, Portfolio rebalancing enhances diversification. In this case, it balances assets. There's that particular, balance, within or between asset classes. Balances, asset classes. Rebalancing ensures all asset classes are appropriately represented, reducing overexposure to one sector or a certain type of investment. It reduces the issue of overexposure. And not only that, it mitigates sector risk. It mitigates sector risk. So in this case, it minimizes the impact of poor performance in any single asset class, sector, or region by maintaining a diversified portfolio. Number four is it takes advantage of market opportunities. Rebalancing takes advantage of market opportunities. In this case, you buy low and sell high. So actually, rebalancing involves selling overperforming assets, often at a higher price, and buying underperforming ones at a lower price. So these strategy locks in gains and position the portfolio for potential recovery in potential recovery in undervalued assets. Number five is aligns with financial goals. Aligns with financial goals. Regular portfolio rebalancing helps you to, it creates an alignment when you are considering your financial goals. So in this case, it supports life stage transitions. It supports life stage transitions. So regular rebalancing adjusts your portfolio as you move through different financial stages, such as accumulating wealth, preserving it, or drawing income in retirement. So all these stages are well catered for, if you regularly rebalance your portfolio. You also have, maintenance. It helps you to maintain asset allocation targets. To maintain asset allocation targets, it ensures your portfolio continues to reflect your investment objectives, time horizon, as well as the desired risk tolerance. Please like this video and subscribe to this channel if you've not done that. Number six is improves portfolio performance. Rebalancing helps to improve portfolio performance. So in this case, it manages risk. By rebalancing, you reduce the risk of being overexposed to volatile assets, creating a smoother investment journey. And not only that, it equally captures gains systematically. It captures gains systematically. Consistent rebalancing help capital. It helps to capitalize on them, on market cycles without relying on market timing. You benefit from market cycles, from changing the market cycle without necessarily timing the market, which is a difficult task to accomplish anyway. Number seven is it helps with tax efficiency. If done strategically, it helps you to create efficiency, in taxes. So tax loss harvesting is a very good example. In taxable accounts, rebalancing can involve selling losing assets to offset gains, while reducing your tax liability. When you sell an asset at a loss, you sell an investment at a loss, it reduces your tax liability compared to if you sell at a gain. That will attract capital gain tax. And you also need to avoid large capital gains. Avoiding large capital gains. Rebalancing incrementally reduces the tax burden compared to large infrequent adjustments. Number eight is build investor confidence. Rebalancing would certainly build your confidence as an investor. So in this case, you consider increased control. It increases investors control over their investments. So regular adjustment ensures your portfolio remains aligned with your plan, giving giving you greater confidence, in your financial strategy. In this case, also, it reinforces good habits. A structured rebalancing schedule fosters disciplined investing by habits, reducing the influence of market noise. So in this case, it inculcates discipline. It gives you the kind of discipline and patience that will help you as an investor, and not only that, it will help you to remain impervious, unaffected, uninfluenced by market noise. Not only that, you have mm, number. We've done number 8. It builds investor confidence. It increases controls, and as well as reinforces and good habits. It equally, we need to ask ourselves, how often do we need to rebalance? How often should we rebalance our portfolio? There's a time-based approach. There is a threshold-based approach, and we equally have a combination approach. So let's look at the time-based approach. Rebalancing annually, semi-annually, or quarterly. You rebalance based on this time approach involve either annually, semi-annually, biannually, quarterly, as the case may be. That's a time-based approach. It's a threshold-based approach. Rebalancing whenever an asset class deviates significantly. For instance, if the particular asset class rises, for example, above 5 to 10% from its target, it could then sell and rebalance. Once it exceeds a particular percentage, like maybe above 5 to 10%, it's time for you to rebalance or to sell all that asset and buy something cheaper. You also have a combination approach. It uses both time-based and then threshold-based method for greater flexibility. It's a kind of hybrid. It's a hybrid kind of system or approach. In conclusion, regular portfolio rebalancing is a vital practice that maintains your desired risk level, enhances diversification, and ensures your investment aligns with your financial goals. It encourages disciplined investing, captures market opportunities, and builds confidence in your long-term strategies. While it requires some effort, the benefits of consistent rebalancing significantly, outweigh the cost. As an investor, it's necessary you rebalance your portfolio, regularly.